All right. Thanks for joining us, everyone, on this FiPro series. A little bit moved to this Thursday, the first. And we have two speakers today for you on business valuation: David Consigli and Rosalia Labate. I never even said your last name before. Did I do it right?
Perfect.
Yeah, awesome. All right, like a pro. And I'll let you two take it away.
Awesome. Thanks. You want to start us off, Rosalia?
Sure. So good afternoon. Jenna, thank you for doing this on our behalf and allowing us to speak to everyone. It's great to be here. So as Jenna said, we're going to be talking about business valuations. So with the holidays coming up, I've kind of been thinking about what to cook. And I want it to be something I'm passionate about, just like my work. And a couple of weeks ago, I had about 13 people over, and I decided to make a lasagna. And when I make a lasagna, I build, the layers, right? So the first layer is the meat sauce, like a lifestyle analysis. The second layer is the ooey gooey, so yummy, like mozzarella, like the business valuation. And the sauce that permeates all the layers is like the forensics that I do. And I take great pride in my lasagna because I want everyone, like my family and my friends, to be happy with all of the flavors of it. And when you're sitting at the table or your clients are sitting at the table for the last time to sign off on their divorce agreement, I want you to be as educated and as empowered and as equally satisfied. I don't want you to be thinking about the things that should have been there or the things that are missing. Kind of like buying a Stouffer's lasagna instead of making a homemade one. It's off, but you don't know why. And I also want to dispel a couple of myths. The number one myth, a CPA can prepare a business valuation. I'm a CPA. And if I didn't have my business valuation training and experience and certification, I wouldn't go near a valuation. It's kind of like hiring a cardiologist to check your vision when you need an eye doctor. Two, many people think that I can only practice in New York, similar to an attorney. In fact, that's not true. I can and have done financial forensics and business valuations in all our states. And I believe Dave has also, right? Dave, do you want to share a little bit about yourself?
Yeah. No, I've actually done valuations in the Vesta Group in Pennsylvania, California. Have also done them in Michigan. So yeah, we can practice. We can practice anywhere. When I first, just to kind of expand on Rosalia's, a couple of myths about valuations, and really you need a valuation expert, not just a CPA. When I first started doing this, I was telling Jenna and Rosalia before they let everybody in the room, that I did my first valuation in like 1996. I said, I think you guys were probably in middle school when I first started, but back then it was kind of the Wild West. Valuations were done by a lot of CPA firms that also did accounting and tax work and financial statement preparation, and still that happens a little bit today too, where you have people that are doing a little bit of both. I made a decision 6, 7, 8 years ago to do valuations, even though I was doing them since like 1996, to do them full time and be an expert. Like if I was truly going to go on the stand and be an expert, I wanted to be an expert. And, one of my friends called me yesterday or the day before, and we were talking, he was telling me how, and he does valuations and he does them pretty good. He's probably the exception more than the rule, but as he was telling me, things are changing so much. I'm sick of my accounting practice. I really want to sell my accounting practice and just do valuations because I feel like I'm not up to speed, and I feel like I got to be an expert. So you even got to be careful there when you're looking at at people doing valuations that are also doing accounting and tax work. Like, look, if you're going to be an expert, you got to be an expert, and this is what you got to do full time. I'll tell you my quick story on how I got into valuation. This is a story I usually used to tell the new hires that had to sit through 8 hours of every different group of our accounting firm doing presentations. I imagine like listening to the tax department and the audit department and on what they do. And I used to tell them this story, that my first divorce engagement, the guy who owned the business wouldn't let us interview him. So we had to depose him. So the attorney had to depose him. So my first question to him was, why did you start your business? When did you get into your business, and why did you start it? And he said, I started it in 19, blah, blah, blah. I had just got out of Walpole for doing state prison, for doing 5 to 10 for armed robbery, and I needed a job. And I went, oh, this is going to be cool. I like this. And I will say, I paraphrased that quite a bit. And the whole deposition went like that. So, do something that you can be passionate about. And I think Rosalie is the same way, because I can hear it in her voice when I talk to her about what you do, and you'll be good at it.
Right. Okay, so let's give you a little taste about in terms of what we'll be discussing here. So I'll be speaking to when does evaluation need to be done, and forensics. David will be talking about standard of value and the approaches, as well as double dipping and professional goodwill. And, the one thing that I want to bring across, because I don't know where everyone is from, and I know Vesta is, obviously a national organization. Divorce does not follow federal law. And it's funny because Dave used the word, and I was thinking of the same thing. Divorce seems to be the wild, wild west from state to state. And even within state, judges make decisions that are, they contradict each other sometimes. So each state has its own precedents and statutes, and, so just something to be aware of. So, I may touch upon some considerations, and David will further discuss them. And know that if you have any questions, please put them in the chat box, and we'll do our best to answer them. Okay, so when does a business need to be valued? I like to think that it needs to be valued all the time, every single time. But the short answer is it depends. In the context of divorce, which is marital divorce, to me is very similar to a business divorce. I think it's important to engage me when you're thinking about it or in the very beginning of it. So we all know Kim and Kanye, the Kardashians. I'm sure everybody knows about them. They got a lot of businesses. And, when they were getting divorced, I would want to be there like day one, or even when they're thinking about it, because we know Kim is going to want it all, right? So say we're talking about, Pete the plumber and his wife, Patty. Is Pete making a lot of money? Is he paying himself less than what he'd get if he went to go work for Sam Plumbing, right? So one of the question becomes, is his business really a job for him, or is it a business asset that needs to be valued for the marital estate, if you will? Some other questions to think about. Do you trust the other side? So I had a client whereby she went to mediation with her husband. Her husband insisted on going to mediation. And she felt very uncomfortable when she left that mediation. And she ended up hiring an attorney, and she ended up hiring myself. During the mediation, the mediator was telling her she didn't need to have her business valued, And it was a family business on the husband's side, so it probably didn't have a lot of value to it. It turns out that the mediator was a college buddy of the husband that the husband brought on board. And looking at the value of the business, the baseline value started at like $37 million. So she felt something in her gut. She had an instinct, and her instincts really served her well in that case. Some other questions to think about. Do you trust the other side to give you a good value? Dave, I don't know if you come across this, but I can't tell you how many times a business owner will tell me that he knows what the value of his business is. I don't know. See, David is smiling, so clearly he agrees with me.
I actually testified about a month ago, and the opposing attorney during cross-examination was saying to me, don't you think the business owner knows the value of their business more than some independent expert? And I said, absolutely not. I totally disagree with you there.
Yeah. So in every single valuation that I've done, there were personal expenses running through the business. I have not done a valuation where I've not seen personal expenses. So the business paid for the family's cell phones, maybe gas for the couple. You know, that factors into all of the financial facets of the divorce. And it's known as unreported income, which I'm going to discuss in a later slide. The bottom line is divorce is one of the 3 top stressful events in one's life. And, you know, don't you and your client deserve to know, you know, what's going on and to be fully informed? And the point is, you know, every fact pattern is different. And I think, and Dave and I also both agree on this. Give us a call. Get our professional assessment. I will most certainly field calls if you have questions or don't know how to handle, you know, that particular aspect. You may not need evaluation, or you may. Okay, so types of valuation services. I think this is another area that people get confused by. So the basic level of service, you know, I will call a cursory financial analysis, where you're using perhaps only tax returns or only financial statements to come up with a quote unquote back of the envelope number. You're not looking at the underlying books and records of the business. There's zero forensics involved. One of the advantages to it is that it's quick and it can be processed relatively quickly. The mid-level range of services, I include something called a calculation of value. In that instance, you may use tax returns and or financial statements. Some forensic activities may be involved. Basically, the valuation expert, the attorney, and the client decide upon what procedures you want to institute. So, you know, you could say that you can agree that maybe we'll just use the income approach in this scenario, and that'll be it. Know that the calculation of value is not admissible in court. A couple of weeks ago, I heard about a judge actually admitting a calculation of value. It was, and it was because the other side had they had no report. They had nothing to present. And so the judge allowed it. So then we have the full details report, which is the highest level of service. In this instance, we generally look at 5 years of information. Why do we look at 5 years? Because 5 years is generally what they say is a full business cycle for a company. And we look at the underlying books and records. We do a site visit. We do in-depth forensic work. Whereas in a calculation of value, you may just look at 2 years of information. As an analogy, so say you have a realtor and you need them to do a drive-by because someone in your family passed away and you need an appraisal of that house. So the first level would be equivalent to that. But say you want a broker to come in because you're thinking about selling your home and you want to get a better idea of what it's worth. So that to me would be a calculation of value. Say that broker is now going to prepare a full report for you because you want to get financing done. Full detailed report. So it's kind of what I have on that. Okay, so David, why don't you take it away with standard of value?
Yep, and just to expand on that, on the calculation report, calculation report, the opinion that we issue says, oh, this isn't a conclusion of value. It's almost like an estimate of value, and it's estimated based on what the client has told us to use as a method. So for litigation purposes, we both agree you do not want to have a calculation of value. The case that Rosalia was talking about, I'm pretty familiar with it because myself and another valuation expert presented on case law, some current case law at the AICPA conference, and that was one of the cases. And what happened was the valuation analyst said, oh yeah, I'll do a calculation of value, but if this goes to court, I need to update it to a full report. Well, they never called him back and they just submitted his calculation of value. And the court threw it out, but then on appeals, the appeals court accepted it, and they accepted it only because they said, well, you can cross-examine him, but it's not fair that they don't get an opportunity to present it. So anyways, that's just something on that. I'm going to talk a little bit about standards of value. And standards of value are really the definition on how, as experts, we're going to value the company. The standard of value is what that state says, what that state law says on how you value that company. So the two we'll go over is from the beginning is fair market value and fair value, because that's what we see the most. Fair market value is a definition that the IRS has created that says, it's the sale of a business or a business interest where neither party is under the compulsion to buy or sell. They both know all the relevant facts and willing buyer, willing seller, and they both know all the relevant facts, right? No compulsion to buy, having all the information, and not being under any compulsion. That's not how businesses are sold. I always say, when I explain this to clients, I always say this is what's called a mythical buyer, because there are compulsions to buy. There are, they don't know all the relevant facts. Businesses are bought and sold on what's called investment value. And what investment value is the value to a particular buyer. So if I'm going to buy a company, if I'm going to buy your client's company, I just explained this to my auto body client. I said, hey, look, if I was going to buy your company, I'm going to probably be closer to this fair market value because I'm just going to be an investor and this is what I'm going to pay. And it's going to run the same way as it ran all the, as it's running now. Investment value is if another company is going to come in and maybe they're going to have synergies. Maybe they're going to eliminate your accounting department. Maybe they're going to eliminate expenses and it's going to be worth more to them. Now, this is a state-by-state rule. Some states in divorce, the standard of value is fair market value. In a lot of states, the standard of value is fair value. And fair value is funny because there's really not a definition of fair value. There is for financial reporting, but for fair value, in essence, is fair market value without any discounts. So it's similar to shareholder disputes where they say it's equitable distribution. So if it's an equitable state, it's usually fair fair value. So there's no discount. So there's no discount for lack of marketability. There's no discount, key man discount. If it's a minority share, there's no minority interest discounts. I can tell you in Massachusetts, and it even varies state to state. Some states don't really say what the standard of value is. In Massachusetts, it's, for the most part, it's fair market, it's fair value, but it's not a definite. So there's a case, Bernier versus Bernier, and there was this family, this gentleman owned some supermarkets on Martha's Vineyard, and in court, he said that I'm not going to ever sell these. I'm never going to sell these supermarkets. So I'm going to die there. I'm going to still own them. So the standard of value was in question. So they said, well, it's fair value, because why should he get the advantage of buying his wife out at a discount when he has no intentions to sell? So, and it's funny too, because every experienced business valuation analyst I know said they worked on the Bernier case. I'm like, it's the only case I know. There must have been like 35 business valuations experts all pitching in to work on this case. But anyways, but in other situations, like if I look at a business and I see that, they are looking to sell and they're looking to get out in the next couple of years, I may take a discount and I may use my fair market value. But it's state to state. There's other things too on, it kind of goes under standard of value in when we look at, as Rosalia said earlier, when you look at like say a small business and maybe it's a sole proprietor, and you look at, do they have a job or is it a company that needs to be valued? Because you hear it all the time. Well, yeah, if I'm not here, it's not worth anything. It's not true. It's what's called value to the holder. And what value to the holder is when, I have a sole proprietor, and like I think Rosalia used, I think, a plumber. I have a plumber and he makes $100,000 on his Schedule C. But if he were to have a job, if he would go to another job, he might make $50,000. So he's making an extra $50,000 a year. Well, that has value, right? And maybe that's worth, $250,000. That's value to the holder. And we'll talk about personal goodwill a little bit later. Can you just go to the next slide, Rosalia?
Yeah, I just wanted to add that as far as New York State is concerned, we go by fair market value, and know that the discounts that are taken can be or are very subjective. So if you're going to court, it could be, you could be opening a Pandora's box, if you will.
Yeah. One of the things about valuation is you'll hear valuation experts talk about it's part art, part science. There's a lot of subjectivity to this, which is why sometimes you can have dueling experts. I always, I don't want to say I like it. I like it better when I go against an expert with a lot of experience than one with not a lot of experience, because I know that and there's one gentleman in Massachusetts that I go against all the time. And, when him and I disagree on things, it's usually on, what's the income going to be going forward. So there's 3 different types of valuation approaches, not to put you to sleep, but so I'll go through them real quick. There's an asset method, a market method, and an income method. So the asset method is where, you simply just add up the assets, the fair market value of all the assets of the company on the balance sheet, you subtract the liabilities, and there you have your net asset value or your asset approach. Companies that use the asset approach are companies that are very asset intensive. The best example I can give you is if somebody has a limited liability company, has an LLC that might hold commercial or residential real estate rental properties in it, right? So if I have a commercial building and it's worth $1 million and I have a $500,000 mortgage on it and I own 100%, then the value is going to be that $500,000, whatever the appraisal comes in at. The appraisal less whatever the debt. So it's pretty simple. So don't see a lot of it. As I say that, I just finished one up today with that where they had multiple properties, and we used like an asset approach on the market method. The market approach is exactly what it says. are there any publicly traded companies that are similar to the company that we're valuing? And we may make adjustments, but we say, okay, this company is selling, its price to earnings ratio is 3 or 4. Okay, we're going to apply that to our subject company's price to earnings ratio. And that's how we're going to come up with a market method. That's the publicly traded guideline method. There's also the private transaction method. And that's where, we'll look at databases and say, hey, there were, we found seven to 10 comparable companies, private companies that have been sold, and this is what they sold for. And then we apply those multiples to our subject company, the company that we're valuing. That becomes very challenging and very difficult. I don't tend to rely on it a lot because they're private transactions and we don't know a lot behind them. We don't know a lot of the backstory. We don't know why it sold. Was it a fire sale? Was it an estate sale? Was it a company that had synergies and was buying that company out? Is it overvalued? Is it undervalued? We don't know that. And then there's the income approach, which I would say the majority of the companies that we value, we use on the income approach. And that's having an income stream. And, it's a pretty simple formula. We're really forecasting what the cash flow is going to be to the owners after everything is paid for. And then we're going to determine what a rate of return is that someone would require. If I could get 15% rate of return on a perfectly diversified portfolio and all these different types of investments, how much more would I want to invest in this privately held company because it's private and it has more risk? And then it's just kind of the simple math. It's the income divided by the rate of return. If it's an unstable company, or if it's, I don't know, maybe the end of 2020, and we really don't know what the future is going to be, then we're going to really try to forecast out and do a forecast and take the present value of those forecasted numbers to come up with our valuation. I made it sound a lot simpler than it is, but at least that gives you some basis on what type of approaches that we're going to look at when we look at your client.
Yeah, you can spend days on this. And I don't know how many of you actually read the reports. I think it's really important to kind of key in on, if you are looking at the reports, how is the expert handling the COVID situation, if those years are in the analysis?
Yeah, I testified 2 weeks ago against an expert that just averaged the COVID year in with everything else.
Yeah. Ooh. That's okay. So why do we need forensics? I looked at the definition of forensic accounting in the Cambridge Dictionary, and basically it was defined as the scientific method to solving crimes. The AICPA, which is a governing national body for CPAs, basically states that it's the ability to collect and analyze and interpret and communicate findings in the courtroom. More simply, in the context of litigation, anytime you need a work product to stand up in court. I like to think of myself as, I investigate dead people, I investigate dead transactions, I investigate dead relationships, I investigate dead businesses, kind of like CSI, but from a financial perspective. So some thoughts to think about on making a determination as to whether or not you may need forensics, you may need evaluation or not. Is there mistrust between the spouses? That may cause someone to want to extend the services. Instead of a cursory review, maybe doing a calculation of value. Something else to think about. Is there a disconnect between the spending and how much money the business earns, also known as unreported income? So what do I mean by that? I've been appointed in quite a few cases with the following fact pattern that I'm now going to describe for you. So let's say we're going back to Pete the plumber's business and his wife, Polly. And his tax returns for the last 4 years showed losses. In the 5th year, Pete the plumber showed income of $35,000. Patty never worked, and they both have 3 children, and they're living in a $2 million house. Doesn't make sense. So the judge appoints me to figure out what's going on because he knows that I know where to look, what to look for, and whether or not Pete's business is worth anything. So Pete the plumber, through his business, pays his wife's salary, funds her retirement account. 2 of his kids are getting a salary and retirement accounts, as well as paying for his car lease, her car lease, the Hamptons second home, and the country club. So going through the business valuation and seeing all of these expenses, these perks actually become part of Pete's income for child support and maintenance. Now, maintenance is also known as alimony. Maintenance is like the new word for it. So now, if you're looking at Pete's income with all of these perks, we could say his income is $750,000 versus the $35,000 that he showed on his tax returns. So, you know, this income also becomes really important with regards to double dipping that David's going to expand on shortly. I guess my point is that, not I guess, I know my point is that if a financial expert had not looked at all of these facets, at all of the financial intricacies of the divorce matter, Patty's maintenance and child support would have been based on $35,000 versus $750,000. So now, David, you want to take over? You want to talk about double dipping now?
Yep, I should probably take myself off mute first. But double dipping, kind of also Rosalia's scenario too. If some forensic isn't done, you know, maintenance agreements are calculated based on income, right? And they could be adjusted from year to year if it changes. But business valuation, if that gets that gets added on, you know, that could affect the value. But let's talk about double dipping for a second. So, you know, what is it? So when I talk about the income method, so we go through the process of what we call normalizing. We start with historic financial statements, and then we're gonna normalize those financial statements. We may adjust the owner's salary to fair market value. We may add back discretionary expenses such as, you know, cell phones for the family members that don't work in the business, you know, auto expense for the owner that never leaves the office. You know, I always look at it as if you were going to buy this business, if I was going to buy this business, what could I expect? What could the perks be to come to me? I'm going to add those all back to the bottom line, right? And that bottom line income is how I'm going to value the business. So I'm going to take that normalized income or cash flow, and I'm going to divide it by my rate of return to come up with a value. So for instance, if it's, you know, $100,000 in cash flow and I have a rate of return of 20, then 20%, then that means the value of the business is going to be $500,000. I'm going to take the $100,000, divide it by the 20% to come up with $500,000. So now it comes time to calculate support. So let's say that business owner gets a W-2 of $50,000 and support, and they're going to calculate support on the $50,000 plus the $100,000 the business makes, right? So support's going to be calculated on $150,000. Is that correct? No, because we've already used that $100,000 to come up with the value of the asset. So you can't use the same income on the business to use as the value of the of the asset. So you're counting that $100,000 twice. We're counting it in the value of the asset, and we're counting it as income. Now, there is a little bit of controversy sometimes on this, in that, in some states it's just kind of cut and dry. Like I have some attorneys that say, no, there's no double dipping. You can't absolutely do it. I have other attorneys that say, and I kind of believe this, that you can double dip in certain scenarios. And I think those scenarios are, does that business have value? Does it have a resale value? Right. So if I have a business that could be sold 10 years down the road, and there's not a lot of personal goodwill, or there's not a lot of, I'm not the only person running that business. If I'm not the sole proprietor plumber, but yet I have a business that can be sold, then that's no different than counting the income in a rental property and then also counting the value of the rental property. So, again, each situation is so different when it comes to valuations and I think that's why sometimes there are certain people in our profession that don't necessarily make good valuators, because they want to have a rule for everything. They want to be able to look it up and say, this is how you do it, but it's not always the case. But that's double dipping, whether you're using the same income to calculate the asset that you're using for the support agreements.
One thing I want to point out is that I know David and I are both talking a lot about court and judges and litigation. These same concepts apply to when you're doing, I don't know if anyone does mediations with their clients, but the same concepts come up as well. So, and I know I've worked as a financial neutral, and I'm sure David has as well. I'm not sure, David, but
yeah.
Again, it's the same concepts.
Yeah, I mean, I've done valuation, and valuation is done in every level of litigation, for lack of a better term. I'm collaboratively trained. I've done valuations in collaborative law cases. I've done them in mediation. I've done them in just where attorneys get together and they go, oh yeah, this isn't really a collaborative case, but we're kind of treating it like one, and we really want to settle it. And I've been the neutral there. And then obviously have gone to, that, like the case I testified in a couple of weeks ago. The guy averaged in the COVID year, and came up with his valuation was $4 million off of mine. So you could see the difference in valuation. In Massachusetts and in a lot of states, professional goodwill is not a divisible asset. I figured the best way to explain professional goodwill is just Google it and cut and paste the definition onto the PowerPoint presentation. The value of a trade or business based on expected continued customer patronage due to its name, reputation, and any other factor. I remember back in the day when I grew up working in a liquor store, and they would say part of the goodwill of a liquor store is if it was on the end of a plaza, if it was the last store on the plaza, that it had more value than if it was in the middle of the plaza, because people couldn't see you going in and out. You can kind of hide and go on the side and go in and out of the liquor store. I don't think that's the case anymore. I don't think anybody cares, but back in the day, they said that was part of the goodwill. There's a distinction between goodwill and so in a nutshell, what goodwill is, I've got a business that's worth $1 million and all my hard assets are worth $10,000, right? The difference is goodwill. That's the difference between the value of the business less the value of the hard assets of the business. And you can break down goodwill, can be broken down, to the minute customer base, customer list, your workforce, all your trademark, your patents or things like that. But goodwill is the value of the business in excess of the hard assets. That can be broken down even more into the goodwill attributed to the owner. Okay, so this is referred as personal or professional goodwill. So the best way to explain this is when we do a valuation of a dental practice. The valuation of a dental practice can be broken up into professional goodwill and practice goodwill. Now, the practice goodwill is I go to the dental office that's in my town of Medway, and it's down the street from me, and I go there. And honestly, I'm going to go there regardless of who the dentist is. If the dentist sells that practice, I'm still going to go there, for the most part, unless they like stab me or something in the eye with the Novocaine by accident. I'm probably, going to continue to go there because where the practice is located, it's in my town, it's convenient, and I'm gonna go. The other thing is, if the professional part is the people that go there just for that dentist. And if that dentist goes to the next town over, they're gonna follow him to the next town over. If that dentist goes to, from Medway to Newton, that they're gonna go to Newton and they're gonna follow that dentist. That's the professional goodwill. How do you calculate it? $1 million question, right? Very difficult to do. And also very controversial because it's not a divisible asset in Massachusetts. I will say this, I am of, and maybe I shouldn't say this because I don't want to make it sound too bad. You hear a lot of times business owners say, well, the business isn't worth anything because it's just me. And my response to them is twofold. Number one, we value businesses as a going concern. So that means that we're going to value the business as it keeps going and it's going to operate just the way it's going now. So like I had one of my own clients once say to me, oh yeah, I think I'm going to get a divorce from my wife. And yeah, you know what? And I go, yeah, you're probably going to have a business value. Goes, yeah, you know what? She can have it if she wants. I'm like, it doesn't work that way. You just can't, because she won't take it. It doesn't work that way. You value it as a going concern, value to the holder. What's it worth to that business owner? The second thing I usually ask them too, when they say the business is only me and it's all professional goodwill, as I say to them, well, you're the only one. You're the only one that can do what you do. No one else does what you do. I mean, to me, professional goodwill is that brain surgeon or that specialty or I thought I actually had one, and the case just settled. It was a cover band. And apparently, this singer of the cover band looked exactly like the real lead singer and sounded exactly like the real lead singer, right? And I told the attorney, I'm saying zero value. Now, he's not making much money, and if anything, it's personal goodwill. And then I talked to him, and I'm like, yeah, it's not like you can go sell it and find somebody to take your place. And he goes, oh, yeah, I could. I'm like, you can find somebody that looks just like this lead singer and sings just like him, just like you. And he's like, yeah. I'm like, all right, well, I guess I got to put some value on this because there's no professional goodwill. But something to think about. If we had more time, I would tell you about some of the tax court updates that we had that people argued about professional goodwill and lost. There was one particular lady who tried to ruin her own company so her husband wouldn't get the value. And then that didn't work. The company still survived without her trying to ruin it. And then she tried to claim that it was all professional goodwill, that it could survive without her. And the judge said, honey, you just tried to destroy your own company and it still survived without you. Never mind you just leaving it without trying to destroy it. So no, there's no professional goodwill.
So in New York, there is no distinction with professional goodwill, just to show everyone how different
each state, yeah, each state is different.
Yeah, and there was actually a case several years ago where a couple was getting divorced. The husband works for a major law firm here in Manhattan. And the wife was so disparaging. She was going to like the New York Post and all these other, other rag newspapers, any chance she got to disparage him. When it came time to divide up the partner, the percentage ownership of the value of his partnership in the business, the judge just gave her bare minimum, and actually in his decision, discussed the way she kind of reduced the value of his partnership interest because she was so disparaging, and it was bad. It was bad.
Yeah, be careful what you ask for, right? Mm-hmm. I think it's also important to point out that a couple things. Number one, when we value a business, it's not the actual business that gets divided. The out spouse, the spouse without business ownership, doesn't get a portion of the shares of the stock. It goes, that value would go in the business owner's column. And then if there's not enough assets, then there's usually some type of, what do you call it? No, why am I drawing a blank? Yeah, there's usually a note to make up the difference in the assets where the business owner will pay the spouse along with the support. In addition to the support, pay the spouse over time for whatever reconciliation there needs to be for assets. We have a case going on where, it's family owned. There's a lot of real estate, and it's probably never going to be sold. And the spouse is saying, well, I'll just take my share percentage in the real estate. So then when it does sell down the line, I'll get that opportunity. But because there's multiple owners, the LLC operating agreement has restricted transfers of ownership. So it's not going to be allowed to be done. Sometimes spouses will agree, but that kind of gets into the whole discussion of, do you really want to be separate? It's kind of like owning rental property. You'll still be connected, in some way.
So I think just to wrap up some considerations to think about, and I hope, we were able to bring these points across. I think it's important to hire a specialist that's credentialed in business valuation, whether it be a mediation or collaborative matter, or, a full-on contested divorce matter. Understand that the different approaches can result in drastically different values for a business. And go ahead, I'm sorry.
No, go ahead, finish up.
Another consideration, know the purpose of the business valuation. Do you have a client like Peter the plumber and Polly, who they know where all the money is. Peter's not making a lot, so they know Polly has a pretty good idea of what's going on with the finances of the business and the home, so they need a look-see. So they may just do a calculation, or is it a complex business where you need to get a sense of all of the finances and what's happening because you had no idea, you weren't involved in the finances, or you suspect some funny business, like going back to Kim and Kanye. Let's say Kim opened up Skims 8 months before she filed for divorce, and Kanye never saw the books and records. He never even saw the cash account, so he has no idea how much she was making. Ye, formerly known as Kanye, would want to look at the Skims accounts. So go ahead, David.
Yeah, I think some of the biggest mistakes as professionals that we make, that I see, is when the clients tell them the business isn't worth anything because it's only me. Okay, that's number one. Or it's all professional goodwill, or it's really a job. It's not, it doesn't really have any value. The other thing too is, you can look, business valuations can be very expensive, right? It could be, not to really, I don't know about Rosalia, but I've seen them $5,000, I've seen them $25,000, I've seen them $30,000 in fees, right? And so, it's something that a client never really thinks of, or we can just come to an agreement. We can come to an agreement on what the value is. If you have a business that's, and it's especially with the smaller business. So let's say it's a smaller business and the fee is probably, $10,000, and they're like, oh, wow, that's a lot. You only have to, let me see, you only have to be off $5,000 in income for $10,000 of value. So if you think about it, right? So if you think about the cost of $10,000 of the valuation being the value of them negotiating their valuation, negotiating what they're going to do for the business. You keep the business, I'll keep the house. The chances of it on a $10,000 valuation fee being off more than $10,000 are extremely high. If they do $1 million in sales, right? I mean, it ended up paying off $10,000 or more. It's definitely worth the bang for your buck. And we spend a lot of time, and I've done it with Vesta, where people will say, can you take a look at these tax returns and tell me whether it's worth doing a valuation and how much would a valuation cost? And I have no problem. I just reminded me I have to contact a banker friend of mine because the other day I got a call from a business owner saying I need an SBA loan. The SBA, I have 3 franchises. I'm getting an SBA loan to buy a 4th franchise, and they require a valuation. And I'm like, an evaluation is going to cost you like $10,000. And he's like, are you serious? Like, they just said I need it. I already know what it's worth. It says it in the franchise agreement. And I said, you know what? I'm going to send you to my banker friend so you don't have to spend the $10,000. Not that I don't want to take your $10,000, but it's just not worth it. And I think the same happens in divorce cases where, you can look at the Schedule C or the small business, and it's like, you know what? This person really just has a job. They don't really have a business. There's really not a lot of value there. And we'll do that all day long. But we'll also tell you, oh, by the way, this is a $10,000 valuation. Like, we're not going to tell somebody it's a $10,000 valuation if it's not worth the risk that they have of really just getting the number totally wrong.
Well, and just be careful, because a lot of times, I have the clients say that they're Schedule C. My wife's a Schedule C, but her part-time job is generating $350,000 a year in net income, right? So I don't know. Sounds like a business to me. So
yeah, value to the holder is really what you're looking at. What's the value to the holder, and that cash flow has value. And I think there's other issues too when it comes to businesses, and we touched on them a little bit. The calculation of income. What's a person's income when they own a business, and that's big, and that's also critical. What I tell people in my Vesta groups, look, if there's a business involved, call me. Just call me. I mean, you got to, there's, I don't know if there's a business involved and you're a trusted professional. I don't know how you don't reach out to somebody. I think it's irresponsible, quite frankly. And it's not, this isn't generating revenue for us. This is helping these people get through a really difficult time. And, sometimes it's telling them the hard truth. And sometimes it's just saying, yeah, you're right. Your wife's little side business is really not worth anything.
Yeah, I was involved. I've actually, and I don't know if you've seen this, David, in some mediation situations where they did not value the business, and they went through with the mediation, because there are mediators out there that think that the couple can do whatever they want to do, which I think is not a good idea. Not a good. I was on a call with a client this morning, and he wants to get divorced, and he doesn't want his wife going into his business, so he's attaching a value to it and asking me if it's right. And I'm like, I have no idea. I haven't seen anything. So it's I think it can potentially be a landmine for your clients. And really, as David had said, give us a call. I'm sure we'll give you, we can give you a professional assessment on everything. So
does anyone anyone, I know there's nothing in the chat. Does anyone have any other questions kind of before we wrap up? One of the things that I also do in our firm is review other valuation reports for other CPA firms. I do it for firms throughout the whole country. There's a firm in California, a very large firm, that I review their valuation reports when they have to, as part of their audit procedure, where they have to audit the valuation report, and they farm that out to us. So that's another thing that I think both Rosalie and I would do in a heartbeat. If you do get a valuation report, is to send it our way and say, hey, can you take a look at it? What do you think? Now you got to take that with a grain of salt too, because I always I always argue that, like, if there's a, an opposing expert that's going to critique my valuation report, my first response is, why did you do did you do a full valuation? We can tell if it's done well, if there's mistakes in it. But to be able to say, no, it shouldn't be, we can say this looks like it's wrong, or this looks like it's wrong, but we can't say, oh, it's $1 million, it should have been $5 million, unless there's glaring errors in it, but we'll do that too.
It depends, right?
Yeah.
It all depends. So anyway, thank you so much for joining us today. Really appreciate it.
Thanks for showing up.
Yeah, and Jenna, thank you for the opportunity as well.